Good morning to all of you who are joining us. My name is Felix Sanchez, a proud Hostos Community College graduate from the class of 2002, and I am the Alumni Relations Manager overseeing the Office of Alumni Relations. On behalf of the Division of Institutional Advancement, the Office of Alumni Relations, and Eugenio Maria, the Hostos Community College, I would like to welcome all of you here with us this morning to our Financial Literacy Seminar Series. We're honored to have members of our Hostos alumni, staff, and faculty joining us this morning. Thank you for being here. A few housekeeping reminders. This presentation will be recorded. I also encourage all of you to please post your questions throughout the presentation using the Q&A feature at the bottom of your screen. We will have a dedicated time at the conclusion of this session to go over them. For the Office of Alumni Relations, it is important to involve our esteemed alumni to transform our communities and the lives of our students. Therefore, for this session's topic, Introduction to Mortgages, Interest Rates Explained, our first panelist obtained an entry-level position at a financial firm and quit college at age 19. At this time, he branched out on his own and moved to the University Heights section of the Bronx. His life was filled with ups and downs, both professionally and personally, but he looks back on his time in the Bronx with fond memories. As a proud New Yorican, he successfully graduated from Hostos Community College in 2015 and moved to Newark, Delaware, where he resides now. He currently serves as an operations vice president for a financial Fortune 500 company and is involved in numerous diversity and inclusion related initiatives. Ladies and gentlemen, please welcome Mr. Pedro Rivera. Welcome, Pedro.
Thank you, Felix. Much appreciated, and thank you everybody for joining this session. As Felix said,
Hear you, Pedro.
Are you unable to hear? Are you unable to hear me? Hello?
Can't hear you.
Hello?
Yet.
You can't hear me?
Pedro, we can hear you fine in the webinar.
Okay. Going. Okay, thank you. Thank you, Felix, and thank you everybody for joining this session. Much appreciated.
Having problem with your audio, Pedro. Sure.
Pedro, you can keep going. We're fine. I think Felix is having a hard time hearing.
Yeah, I'm just letting
him know. I can hear you, yes. I can hear you.
Oh, now you can hear me. Oh, okay, there you go. Sorry about that, everybody. My name is Pedro Rivera. As Felix mentioned, I'm originally from New York City, grew up in the Lower East Side till I was 18, moved out to the Bronx when I was 18, lived on my own. Very rough time in the year 2000 to live in the University Heights section of the Bronx, especially not being from the Bronx, but definitely whenever I tell folks where home is, I tell them it's the Bronx because that's where I had my adult years from 18 going forward. And the reason why I decided to do this course was because growing up, I grew up in the projects, low income housing, grew up on welfare, never thought I'd ever own a house. And, you know, my mid 30s, when I moved to Delaware, I was able to purchase my own home. And it was probably my crowning achievement in life. And it's because, you know, growing up in a small 2-bedroom project apartment, you know, sharing a bedroom with a brother and a sister, and now having my own home, and I'm able to I actually garden, and I actually mow the lawn, and I actually can park in my driveway. These are all things that if anybody who owns a car in the Bronx or owns a car in New York City knows, the simplest pleasure is being able to park your car. Like everybody knows how bad parking is. So I decided to do a course on mortgage rates, and I want to make sure that folks understand, you know, how to not get stuck in the pitfalls of, you know, picking the wrong type of mortgage, and, you know, and also just to be aware of so you're not taking advantage financially, because, you know, oftentimes you've heard about the mortgage crisis in 2008, where mortgages were given to individuals who didn't necessarily, you know, qualify, and they lost their homes. You know, so it was a huge, you know, epidemic in California and other places. So my goal is to make sure that, you know, everybody on this call is able to understand where, you know, what type of mortgages are out there, what to look out for. And by all means, just understand this is not financial advice per se. Everybody can make their own decisions, but at least if I present what's out there, and if you guys have any questions and you want me to answer them, I'll answer them to the best of my ability. So Let's get started. So mortgages are an essential part of the home buying process for most borrowers who aren't sitting on hundreds of thousands of dollars of cash to buy a property outright. I know I wasn't, right? Like if you don't have, $500,000, $1 million sitting in your bank account, you need to get a mortgage. And what's a mortgage? Mortgage is basically when you go to a bank for financing of a home. So it's financing of a home, right? So you go to a bank or a financial institution that specializes in mortgages, and you present to them your income, your credit score, and different financial attributes to you, and they have like a formula that they have on their systems that lets you know whether they'll loan you the large sum of money to buy this home. Now, when they do lend you this money, the bank owns the home. You're basically paying the bank back for the loan. Now, with mortgages, 99% of all mortgages, you have to have what's known as a down payment. You have to put up some money. Some financial firms require 20%. So if the home's $1 million, you got to have $200,000 in your bank account to put up. So that's their way of saying, okay, you put up 20%, we'll put up the other 80, and you're going to pay us back over a determined amount of time, the 80% at an interest rate, right? And I'll go through what types of interest are out there momentarily. So that's some financial firms do what's known as FHA loans, which is a Federal Home Association loan, where it's a lower percentage. You have to come to the table with 3.5%. So with 3.5% on $1 million mortgage, that would be $35,000, right? So as you could see, $200,000 compared to $35,000, it's way different. But understand that you're going to pay a lot more money and interest and principal back to the bank because you only put up 3.5%. So understand that there's a huge difference between a conventional mortgage and an FHA mortgage, which is it's basically sponsored by the federal government. It's called the Federal Home Association loan, FHA loan. So it's going to take you longer to pay back your home with less down payment. And it's the same thing as buying a car. If you buy a car and the car is $10,000 and you go with no down payment, understand you're paying that $10,000 plus interest back to the car dealership. It's the same concept. The only thing is we're dealing with much larger dollar amounts. We're dealing with hundreds of thousands of dollars. And so imagine a bank's not after the mortgage crisis, a lot of rules were implemented. So banks don't just freely give mortgages to just anyone because we don't want another financial crisis like we had back in 2008. But doesn't mean it's impossible for you to get a mortgage. Like I said, it just means that you just need to make sure that you're very responsible with your financial decisions. Try not to have high credit card debt. Do everything you can, pay your bills on time so that your credit score is not affected. There's a lot of little things, and maybe at the end of this call, I might go through some of those things just to, and if you have any questions on those types of things, just throw them in the chat and we'll get to them at the end. But let's go through the mortgage, different types of interest, right? So there's two types of interest that can be provided for a mortgage. There's fixed rate and adjustable rate. The word fixed, right, means constant, same. So fixed rate mortgages have the same percentage every month. Adjustable, as the word says, it can change. But it's not as simple as what I'm explaining. I'm just saying that when you think about it, just think fixed and adjustable. Obviously, they're opposites of one another, but we're going to go deeper into each one. So let's go with the conventional one. So fixed rate mortgages and adjustable rate mortgages, there are two types of mortgages that have different interest rate structures. Fixed rate mortgages have an interest rate that remains the same throughout the term of the mortgage. While adjustable rate mortgages are ARMs, you may see ARMS, ARMs, right? That's the acronym for adjustable rate mortgages. They have interest rates that can change based on market trends. See, market trends. So it depends on what's happening on the market. Your rate can go up or down. Whereas fixed will stay constant in a linear path. So let's learn more about fixed rate mortgages compared to ARMs or adjustable rate mortgages, including the pros and cons of each. Here's some key takeaways for what we're going to discuss. A fixed rate mortgage has an interest rate that does not change throughout the loan's term, as I mentioned. Interest rates on adjustable rate mortgages can increase or decrease in tandem with broader interest rate trends. The initial interest rate on an ARM is usually below the interest rate on a comparable fixed rate loan. So the ARMs usually start lower than what's normally on the market, what would be a fixed rate. ARMs are typically more complicated than fixed rate mortgages, as you could tell, because the rate can change. So that just adds a little complexity to the mortgage, right? To your what you're paying every month. So let's do a little comparison, fixed versus, right? Fixed rate, set interest rate that does not change throughout the life of the loan. Typically makes it easier for homeowners to budget. If your mortgage payment is the same every month, just like your rent, it makes it easier when you start budgeting electricity, food, gas, whatever you're gonna pay, Con Ed, or I'm dating myself by saying Con Ed, but you know, whoever your power company is. I haven't lived in New York in 7+ years. But when you start doing your budgeting, a fixed rate kind of gives you the same amount every month, right? Typically, and then provides protection from sudden changes in the mortgage rates. So just to give a little like market activity, right now, interest rates are about 7-8%, whereas 4 years ago, you could get a mortgage, actually right before COVID, you could get a mortgage for about 2.5 to 3%. Now, 3 to 7, which is, only four percentage points, doesn't sound like a lot, but again, we're talking about hundreds of thousands of dollars. So a mortgage right now, like the amount you would pay on the same house, not because the value of the house went up, it's because the mortgage rate went up. You're paying a good $500, $600, $700 more now for the same house, only because the interest rates went up. And that's because because of the economy we have right now with inflation, interest rates are increased. Whenever you have inflation, interest rates go up. Now, that's a very simple statement, and I don't want to get into that part of the economics of it, but I just want to say a comparison that 4 years ago, pre-COVID, interest rates were very low. We weren't in a risk, we weren't dealing with the inflation that we're dealing with now. So now interest rates are pretty high, right? So, just wanted to put that out there. That's why a fixed rate provides you that protection. So if you had a fixed rate from 3 or 4 years ago at 3 or 4%, right now that mortgage seems like a bargain, because if you were to buy a new home today, it'd be 7 or 8%. So, just to keep that in mind with a fixed rate mortgage. And a fixed rate mortgage is also difficult to qualify if interest rates are high. And here's why. If the interest rates are high, your mortgage, the amount you pay for your house, is going to be high. So that means you have to make more money, right? If the interest rates are lower, you can afford more of your mortgage, right? So if the interest rates are high, like I mentioned, the same price that you're paying right now, at, with a lower mortgage rate, freely we'd be able to, like, as a financial institution, we'd be able to give you the mortgage, because we say, based on your income, based on your credit, based on everything else, I can give you this mortgage. But if the interest rates are 5 or 6 points higher, and now the mortgage is another $1,500 for you to afford, you're making the same amount of money in both scenarios. But now, because the interest rates are so high, I can't extend that mortgage to you, because you wouldn't be able to pay your mortgage and pay your bills. So that's why it's a little, keep in mind that the higher the interest rate, the more money you have to make, right? Adjustable rate mortgages. So the rate is set below the market rate on a comparable fixed rate loan that rises or possibly lowers over time. Typically, it's more complicated than the fixed rate mortgage. Typically much cheaper than a fixed rate mortgage, at least in the first 3 to 7 years. You'll commonly see stuff like ARM 3, ARM 5, ARM 7. Those mean that in 3, 5, or 7 years, the mortgage rate's going to change. And you're basically gambling. You're gambling in 3, 5, or 7 years that, A, the economy gets better, so maybe your mortgage will go lower. So if it doesn't, understand that in 3, 5, or 7 years, or whatever the ARM rate is, your mortgage can go up for the same house. Now you're paying more interest. So, it makes it somewhat of a nightmare budgeting wise, because if you're used to paying, if you make X amount of money and you're used to paying this amount for your house, and then in 3, 5, or 7 years or whatever the term is, like right now, how I mentioned, it's 8% on the mortgage rate, and let's say you bought it when it was 3%, that 5% can wreck your budgeting, because now you're paying an extra $1,200, $1,500 for the same house because the interest went up. So, there's some, you got to have a little bit, you got, either if you have a financial advisor or if you have some knowledge of the mortgage, the mortgage rates and things like that, and you want to go that route, understand that there's a lot of risk involved. So, and as I mentioned, your monthly payment can change frequently, making it difficult to budget. So keep that in mind as well too. Like for me, I'm more of I like doing things the same way. Not that I'm not innovative. I do adapt to change, but I like stability with certain things like bills and things like that. So I would prefer, like for example, I have a fixed rate mortgage only because for me at the time that was the best thing, and I didn't want to gamble, and I'm glad I didn't, right? I didn't want to gamble and get an adjustable rate ARMS, mortgage, because right now I'd be paying an extra, $1,000 for the same house and I'm literally just paying that in interest. So for me personally, I'm glad I didn't get an adjustable rate mortgage, because like I said, I would have been paying more right now, So let's go into fixed rate mortgages, right? So fixed rate mortgage has interest rate that remains unchanged throughout the loan's term. So your payments will remain the same each month. However, the proportion of the principal and interest will change. Let's get into what principal is. Principal is when you pay your mortgage every month, your mortgage is split into different facets. Principal is the actual ownership of the house. So if my mortgage payment is $1,000 and 600 of it is principal, that means I now own, at the end of that mortgage payment, I own $600 worth of my house back. Because remember, you're paying the bank back for the money they put up. So let's say the bank put up $100,000 for your house. You're paying them back. Out of that $100,000 that they put up, I now, after this month, own $600 worth. And then next month, it might be 601. Because the way it works is principal and interest are inversed to each other. In the beginning of your mortgage, your principal amount of the payment, the total payment, is lower and your interest rate is higher. But as you pay back the bank, your principal payment increases and your interest payment decreases, because the interest is based on how much you owe the bank. So if I owe the bank $100,000, right, on 4%, that's $4,000, right? So that's how much interest I would be paying. But then if I own $80,000 of the $100,000 that they put up for me, now they only own 20% of my house. So now my interest is going to be lower because they're charging me interest on the $20,000 that's left, not the full amount that they loan me. So keep in mind that interest and principal are inversely related to each other. So mortgages at the beginning, you don't pay as much principal, but towards the end, your payment is almost all principal. So let's say and keep in mind, so mortgages can come in different terms. Just understand 30 years is the standard, but it's not the only type of mortgage. But so what they're saying is, I'll lend you this much money for your house, and you have 30 years to pay it back. You have to pay back in installments every month for 30 years, right? Or there's 20, there's 15, and for I don't know, they have 7, but I've never seen anybody do a 7-year mortgage because you'd have to put up a lot of money, right? In a 30-year mortgage, your housing payment, your mortgage payment is a lot lower, but you're paying a lot more interest, right? Because you're paying interest over time, 30 years worth of interest. In a 20-year mortgage, so as you go down in years, for a 20-year mortgage, your mortgage payment is a lot higher, but you pay off your home in 10 less years, and you also pay less interest. But understand that you're putting more money into the mortgage every month because it's a 20-year mortgage. So they're saying, we got to get this $100,000 I lent you. I got to get it back in 20 years. So you're going to pay less in interest, but understand that your mortgage payment is going to be a lot more because you got to catch up. Those 10 years that you're not going to make payments to them, you're going to pay more every month. And then obviously 15 and 10, like your mortgage payment just starts increasing, right? So if you could afford it, great. Not everybody can afford a 15 or 20-year mortgage, like you found your dream home and it's a certain amount of money. So you might need to get a 30-year mortgage. But it doesn't mean that you have to spend the next 30 years making payments on that home, because there's such things as extra principal payments throughout the month. So with an extra principal payment, let's say my mortgage is $1,000, and out of that 1,000, it breaks down to 600 principal, $400 of interest, right? But I go, you know what? I had a bonus at work or whatever. I'm getting a bonus for for sales. Like I sold a lot of stuff, whatever you do for a living, and I got an extra $200. You could throw that $200 into a principal payment. So now this month's payment is actually $800 worth of principal, not 600, and your interest rate will actually go down lower. That's how you pay a mortgage faster. You pay your mortgage payment, and then you add a little extra money every month in principal. And if I'm adding more in principal payments, that means it's less money I owe the bank. So if you throw, I know somebody who had a 30-year mortgage and she actually paid it off in 15 years because every time she got a bonus, every time she got some type of extra income, she threw it into her house. And she paid a lot less interest because she did a little extra, $200 extra on a mortgage every month. You will pay that mortgage down a 30-year in 20 years or 22 years, depending on how the math works, because you're doing extra principal payments throughout the month. Now, I know I deviated from mortgage rates, but I thought that would be a good caveat to the conversation to kind of, give back. Like mentioned, there's ways of, paying your mortgage down a little faster. So I'll go back to the subject matter. So as I mentioned, the fact that your fixed rate payments remains the same provides predictability, right? As we mentioned, the main advantage of the fixed rate loan is that the borrower is protected from sudden and potential significant increases in monthly mortgage payments if interest rate rise. Fixed rate mortgages are also easy to understand. Potential downside to fixed rate mortgages is that interest
Pedro, I'm sorry. I think that we can't hear you. Pedro?
Pedro, I think we lost your audio.
Pedro, we can't hear you. Pedro, we can't hear you.
Are you able to hear me now? Okay.
Now,
There you
yes,
go.
we
Perfect.
can. Yes.
Yeah, sorry about that. My headset died. As I was mentioning, so all right, so sorry about that, guys. I was mentioning, so with the mortgage rates, if you want to refinance your mortgage, which means I want to lower my interest rate, I have to go through the whole closing process again. Whenever you get a mortgage, there's a lot of things that are involved. You have to get an inspection of the home. You have to get approved with your pay stubs and your W-2s, things like that. They want to show that you have financial ground in order to qualify for the fact that they're gonna put up this money for this home. If interest rates do decline with a fixed rate mortgage, understand that you can't take advantage of lower rates unless you refinance, which is you have to go back to the bank, show them all these documentation again to get a new mortgage. It's called a refinance. It's like getting a whole mortgage again. So understand that that's considered a downside to the mortgage process, right? Like to a fixed rate mortgage. Like you have to go through all the steps again. And for some folks, getting a mortgage is a very, I don't want to say traumatic. It's just that there's a lot of work involved. You have to provide a lot of documentation. You have to show that your credit's good. You have to show that you make a certain amount of money, and you have to show good payment, history, things like that. So with that, some folks would rather not go through that process all over again to take advantage of lower interest rates. Some folks don't care. They'll refinance because they say, you know what? I'll go through those steps because eventually I'm actually going to pay a lot less money every month. It takes a month or two to get a mortgage done. I'll just go through. So it pros and cons, right? Like, so how do fixed rate mortgages work? So mortgages work on what's known as an amortization. Amortization is where you are paying down the loan. As I mentioned earlier, your principal amount increases as your interest rate decreases throughout the life of the loan. So, for example, if your mortgage payment is $600 and your principal is $100 of the mortgage, your interest would be 500, right? So 1 and 5. But then the next month, same mortgage payment, $600, because again, with a fixed rate mortgage, your payment's the same every month. Nothing changes. But your principal amount increases. So let's say payment number 2, $600, but now your principal is $101 and your interest is $499. So now you see you paid $1 less interest the next month because you have some principal, you have some ownership. Principal, think of principal as your ownership of the house. Because when you get a mortgage, you don't technically own the house yet. The bank owns the house. They put up the money for it. You're paying the bank back for putting up the money to buy your home. But at every month that you pay back the bank, you own a little bit more of your home. And then when you get to the end of the mortgage term, you 100% own your home. That's it. Like you own your home and it's yours. You own the land, you own the house, you own everything about it. But you got to pay property tax, right? So the state that you live in says you may own the home, but you still got to pay tax on the land that you own. So that's how schools are funded. That's how roads get built. So it's one of those unnecessary evils, right? You pay property tax, and you pay a school tax for where you live, but it's one of those things that we all have to like pitch in and we all have to do, right? Like I don't have children of my own, but I pay school tax with my mortgage, with my property tax. I want the schools in my where I live to be great because that increases the property tax value, but that also helps educate the next generation. So for me, paying property tax is not a big deal. Like for me, it's more I'm giving back to my community and I'm giving back. I'm actually making my home increase in value, so everybody wins, right? So adjustable rate mortgages. So let's go into, because that's the one that's more complicated, right? The interest rate for an adjustable rate mortgage is variable. The initial interest rate on the ARM is lower than the interest rate on comparable fixed loan. Then the rate can increase or decrease depending on broader interest rate trends. After many years, the interest rate on an ARM may surpass the rate of a comparable fixed rate loan. ARMs have a fixed period of time during which the initial interest rate remains constant. That's the 357, right? After that, interest rates adjust at specific regular intervals. The period at which the interest rate can change can vary significantly from 1 month to 10 years. Shorter adjustment periods generally carry lower interest rates. So note, after the initial term, an ARM loan interest rate can adjust, meaning there's a new interest rate based on current market rates. This is the rate until the next adjustment, which may be the following year. So if the interest rate goes up, you may get stuck with that adjustable rate for the whole year. Even though trends change, they say, no, now it's locked in for this particular period of time. So how do they work? Key terms. ARMs are more complicated than fixed rate loans, so understanding the pros and the cons requires an understanding of some basic terminology. Here's some concept you should know before deciding on whether you get a fixed or an ARM. Adjustment frequency. This refers to the amount of time between interest rates, monthly, yearly, etc. Right? Adjustment indexes. Interest rate adjustments are tied to what's known as a benchmark. Right? It's like so something that happens, a benchmark. Sometimes this is the interest rate on a type of asset, such as certificates of deposit or treasury bills. Those are securities, right? It could also be a specific index, such as a SOFR rate, SOFR, secured overnight financing rate. That's a specific rate on the market. It's called a SOFR rate. The cost of funds index, or the London Interbank offered rate, which is called the LIBOR, LIBR. So there's different. That's why they say that ARMs are so complicated, because they're in the terms and conditions. They'll tell you what it's based on, but it also requires some homework on the purchaser's part. I wouldn't just depend on the bank to make these decisions for me. That's why I want to do this course for folks, and I want you guys to ask me whatever questions you have, because this way you could come in if you when it comes time, because I am fully confident everybody on this call will eventually buy a home of their own, and that's my hope for everybody, because like I said, it's simple. And if you don't, that's okay too, right? Some folks don't want to buy a home, but for me, I want to be able to just throw all this out there for you guys, and you can ask your questions, because I know that this is not stuff we learn, especially in the New York City public school system, which I'm a product of, right? So I want to make sure that everybody here at least has this information up front, whether you're going to buy a home tomorrow or you're going to buy a home 10 years from now. At least you could remember this conversation, right? And you can, do your own homework, and some stuff will now click in your mind 5 years from now. You're like, yeah, I remember hearing something about that. Let me read into it. That's always the way I work as well too. So with all those different types of benchmarks that I mentioned, it can get complicated, right? So another term, margin. When you sign your loan, you agree to pay a rate that is a certain percentage higher than the adjustment index. So for example, your adjustable rate may be the rate of a 1-year treasury bill plus 2%. It's getting complicated, team, right? Guys, it's getting real complicated. Now they're talking about treasury bills, which are, you're investing in the federal government, buying a bond. Whereas a fixed rate, the bank just comes to you and says, hey, the mortgage is 7%. That extra 2% that I just mentioned, the treasury bill plus 2%, is called the margin. So you're agreeing to that margin payment based on a market indicator, which is the treasury bill. Caps. This refers to the limit on the amount of interest rate can increase for each adjustment period. Some ARMs offer caps on the total monthly payment. These loans are also known as negative amortization loans. Keep payments low. However, these payments may only cover a portion of the interest due. Unpaid interest becomes part of your principal. After years of paying your mortgage, your principal owed may be greater than the amount you initially borrowed, which means that if you borrowed $100,000, you might actually owe $140,000, because of that cap. Ceiling. This is the maximum amount that an interest rate can be during the loan's term. So from a budgeting perspective, if you use the ceiling and you're comfortable with the ceiling and you could afford it, then great. You say to yourself, this is the highest I could ever pay, right? I'm okay with that. Some folks may say I'm not okay with that. So again, these are decisions that you have to make for yourself. A major advantage of an adjustable rate mortgage is that it generally has cheaper monthly payments compared to a fixed rate mortgage initially. So the first couple of years of the mortgage. Lower initial payments can help you easily qualify for the loan. Important though, when interest rates are falling, the interest rate on an ARM mortgage will decline without the need for you to refinance the mortgage. That's the difference. In an ARM, the interest if market activity says lower the interest rate, that's the whole point of the adjustable part of it. Your interest rate will lower. You don't have to go through the whole refinance process again. But it's risky. That's if interest rates lower. If they increase, you're going to pay more. Whereas with a fixed rate mortgage, you don't pay more. The interest can go up to 10%. If your mortgage on a fixed rate is locked in at 4%, you are only paying 4%. You are not going up to 10%. Hence what I mentioned earlier in the call, that there's an advantage to the fixed rate mortgage. It doesn't matter what happens with market activity, you can pay the same. So a borrower who chooses a adjustable rate mortgage can potentially save hundreds of dollars a month for the initial term where it doesn't adjust. Then the interest rate may increase or decrease based on market rates or the other indicators or benchmarks, right? If the interest rates decline, you'll save money. But if they rise, your cost will increase. ARMs, however, have some downsides to consider. With an ARM, your monthly payment may change frequently over the life of the loan, and you cannot predict whether they will rise or decline or by how much. This can make it more difficult to budget mortgage payments in a long-term financial plan. And if you're on a tight budget, you could face financial struggles if interest rates rise. Some ARMs are structured so that interest rates can nearly double in just a few years. If you cannot afford your payments, you can lose your home to foreclosure. Foreclosure is the process where the bank says, you're delinquent, you haven't paid your mortgage payments, we're going to evict you basically, and we take ownership of the home, which we do have ownership, right? Because we put up the money up front, and you default on that loan, and now the bank has to sell the house on the market. So, now indeed, adjustable mortgages went out of favor with many financial planners after the subprime mortgage meltdown of 2008. I mentioned the mortgage crisis, 2008 earlier, which ushered in a new era of foreclosures and short sales. So with that financial crisis, a lot of folks were getting, mortgages they couldn't afford. And think about it, folks couldn't pay for their homes. So there was a huge crisis where, folks were getting kicked out of their homes, foreclosed on, and the bank had to sell these houses at a lower rate than what was owed. Borrowers faced sticker shock when their ARMs adjusted and their payments skyrocketed. Since then, government regulations, legislations have increased oversight on ARMs. So with the mortgage crisis, what essentially happened was, like I said, they gave out ARMs mortgages to individuals who they could afford the initial ARM. But when the interest rates went up, what they couldn't afford that increase. You shouldn't give a mortgage to somebody, an ARM mortgage, if they can't afford the ceiling, right? So what happened here was folks couldn't afford the ceiling, and when they got the sticker shock, like my mortgage went from $1,000 to $2,500. Imagine your rent or one of your bills goes up by $1,000, $1,500. Most people would not be able to absorb that. Like out of nowhere, I'm saying, like not that you had time to adjust, like just out of nowhere, $1,500 more you have to pay for your home. So that's what happened in 2008. And, and I definitely would, like for everybody else on this call, look into financial crisis 2008 for more information on what happened. And, because history can repeat itself, right? Like we need to be financially educated on these types of things. So look into it, because if any of you were paying bills around that time, and you'll know that crunch that happened in 2008, it affected everybody. It wasn't just mortgages. So, do a little bit of homework and look into that. So, is a fixed rate mortgage or an ARM right for you? That's up to you. Like, I mean, I'll give you some food for thought. but I'm not going to tell you which one to get because again, that I don't want to provide financial advice. But if it's right for you, I'll just give you some food for thought. When choosing a mortgage, you need to consider several factors, including your personal financial situation, the broader economic conditions. Ask yourself these following questions. What amount of a mortgage can you pay comfortably? Could you afford an ARM if the interest rates increase? Even better, can you afford the ceiling, the highest amount it can go to? How long do you intend to live in your property? That's the other thing. If you don't like where you live, buying a house is not going to solve that. So keep that in mind because this is a long, arduous process of saving money, qualifying for the loan, closing on the loan, getting an inspection of your house and making sure that you like the neighborhood, the schools. There are so many factors into choosing a house. So if you say to yourself, I'm lukewarm, I love the house, but the area I'm not really too fond of, think twice before you buy the house because you may not want to be there long term. But if you fall in love with everything about it and you just say to yourself, you know what, I could settle my roots here. Like for me, I lived in Delaware a year before I bought my home and I said, this is where I want to live. It's quiet. It's boring. That's exactly what I want. I don't have to take the 4 train for an hour to get to work. That sold me, right? So I planted my roots here. So understand that buying a home is it's probably one of the most difficult decisions you will ever make in your life. So really think about how long you intend to live there and if that's where you want to plant your roots. Of course, people always sell homes. They get up, they uproot, you get a new job, whatever it is. But in the present, think about whether that's where you want to stay. And then what do you anticipate for future interest rate trends? Like if you say to yourself, historically right now rates are kind of high, maybe put it off. Or if you say to let's say rates are low and you say to yourself, wow, it hasn't been 3% in a long time. I think now's the time for me to buy a home. I saved up enough money and I really like living here. All these different factors we just spoke about. Pull the trigger. You start looking into the process. So if you're considering, an adjustable rate mortgage, understand that you should calculate payments for different scenarios to make sure you can still afford all the way up to the maximum cap. For fixed rate, you know how much you're paying every month. So that's you make your budget based on that. So just understand that there's 2 different rates. So that's my spiel on adjustable versus fixed rate mortgages. Sorry for the technical difficulties earlier. What I guess we should do now is open up to any questions and I'll kick it back to Felix and they're pouring in. All right, let's go. Who's got questions?
Pedro, thank you very much for this productive and informational session. So we're going to go over now, as you mentioned, to some of the questions that our attendees posed during the power your presentation, indeed. So the first question is, if a person owns a house with a FHA loan and it's planning to buy a second property with a conventional loan, does it have to be 20% or can that individual put down just 5%?
It would have to be 20% from what I've seen because the FHA, you can't get multiple FHA loans. FHA loans are for what's known as primary residence. So you have to live in the house that your FHA loan is given for. The reason why you're putting up less, a lower percentage, is because that's your primary residence. FHA loans are not for investment. So yes, you're going to have to put up 20% on any additional house that you buy.
Excellent, thank you. Second question, could you please speak about pros and cons of HELOC loans and whether it's a good idea?
Okay, so the HELOC, home equity line of credit. So HELOC's not a type of loan. HELOC is you already own your home, and that's known as a home equity line of credit. So so folks have credit cards, right? Like and a home equity line of credit says, we're gonna give you a certain credit limit that you can pay for stuff, but it's based on your home, how much home equity you own. So lower interest rates compared to a credit card, right? You could actually get, so think about it this way. Credit cards are probably at what? 20% interest, 18%, 22, depending, right? If you get a HELOC, your HELOC would be around what a mortgage rate, which is, let's say right now it's 8%. It's still lower than a credit card. So positives of a HELOC is I could have a line of credit based on my home at a much lower rate. So it's a lot cheaper for me to pay it off. So think of it as like, and some credit companies give you a MasterCard that's locked to your HELOC, which is great because you're swiping a MasterCard and unlike using a credit card, you're going to pay a lot less interest. But as everything in life, if you can't pay your bills, know that counts as a default of your mortgage because you're basically saying, I'm taking a home equity, what I own in my home, right? What's in my pocket, my home. And I'm saying, give me a line of credit based on that. If I can't pay that back, now I got another bank I got to deal with. You have the first bank that owns your house, which is your mortgage company. Now you got a second bank that has a lien or an ownership stake in your house on a line of credit. So it's great from an interest rate perspective because if you need a credit card, this is a lot cheaper, but there's risk involved. Unlike unsecured credit card where they have no ownership stake in you, in a HELOC they do. They own that portion of your house because you're giving up some equity for that line of credit. Now, if you keep the line of credit, you pay it off every month, or you pay it down, and you've got nothing to worry about. And now you're only paying based on whatever your mortgage is at, like when you get approved for the HELOC.
Right. Thank you for that. And final question so far, would you advise on considering refinancing in order to lower interest rates?
That's the whole purpose of refinancing. So not that I advise, but I'll tell you for now, refinancing, the whole purpose of refinancing is to get a lower interest rate. So right now, unless your mortgage, so here's how I look at it. If your mortgage is higher than what the market is now, you could do a refinance calculation. If you just put refinance calculator in Google, you can see how much your rates would be, let's say today's mortgage rates and what you're paying right now. You could do a comparison and say to yourself, let's say it's only a $200 difference. Would you really go through the whole refinance process? Because refinance, you got to pay a company to refinance your mortgage. You got to pay like your closing costs. So it can cost anywhere between $1,000 to $4,000 to close a mortgage, depending on the value of your home. So yeah, I'll pay $4,000 right now, but let's say it's a lot cheaper to refinance right now. I would absolutely do it, right? Because I pay the $4,000 now, but over the life of the loan, I'm saving, let's say $20,000. No brainer. Pay 4, save $20,000, but also keep in mind the considerations that we spoke about how long do you intend to live in the property? Is it, like, can you afford it? Things like that. So refinancing has the same questions that I mentioned earlier, but understand that you should use a calculator first to make sure that it's feasible.
Absolutely. Well, Pedro, it seems that we don't have any more questions. We just wanted to thank you again for your time this morning and those in attendance as well for taking some time of your morning to listen to very good practices in regards to mortgages and the best tools to use out there in the market. Our message for our Hostos alumni today is to please encourage you to stay connected with our institution. Please help us make a difference in our communities and to showcase the power and talent that our Hostos students and alumni represent. Please follow us on social media, the handles you see on the screen, to keep informed about the Alumni Relations Office upcoming and exciting events. Stay tuned for our next topic, probably today at 11:30, which is identity theft, as we continue our financial literacy seminar series. On behalf of Hostos Community College, the Division of Institutional Advancement, and the Office of Alumni Relations, thank you for spending time with us. I'm Felix Sanchez, Alumni Relations Manager, saying so long. Have a great day, everybody. Thank you, Pedro. Everybody have a nice day.
Have a great day.